Welcome, guys. I'm sure that all your opinions will be very valuable to the room because I already know some of the points you'll try to focus. And I'll start with you. We start about talking about trends. What kind of trends in which asset classes and in which asset classes do you see assets flowing in Europe nowadays?
Great question. There's many things happening. Thanks for having me, first of all, and I'm very glad there's no disclaimer behind me. I've got a few notes because there's a few interesting points this year, which is quite new for the ETF market in the ETF industry. I would say one thing: everything is relative in this industry. The ETF industry, to give you a rough idea, has gathered over $50 billion this year in Europe. So your peers in this room have poured net of flows 50 billion. For me, it doesn't say anything. If I flip to the overall asset management industry, it's 100% of the net flows. So we are in an ETF year in the asset management industry. I think that's very interesting. Massive outflows on mutual funds, massive inflows on ETFs in particular. 3 trends. I'm not rolling up the drums because you won't be surprised. First and foremost, ESG is an important trend in the ETF market. I think there's been 34 new products being launched this year, and 28 of them are ESG ETFs. When I say ESG, I mean sustainable. Article 8, Article 9 under SPDR regulation, and this is where most of the money is flowing. Second, fixed income. This is quite surprising. This is the very first year that we have an equity year in terms of flows. So once again, you in this room and your peers have poured into equity ETFs this year. Not surprising. The big surprise is this summer. Since July, the flows have been positive on fixed income and negative on equities. I would relate that naturally to the macro conditions, the uncertainty, the rising interest rates as well, and clients, investors pouring back into the market with fixed income and not equities, being a bit hesitant. And third, a new trend that is picking up and pretty much doubling every single year, something that I was expecting because I've been working in that industry for quite some time, is actively managed ETFs. It's a new trend. It's the blend of both worlds of the availability of a portfolio, the flexibility, the cost efficiency, but also the features of the convictions of a portfolio manager. And then all of a sudden you get the blend of both worlds. And I think that's an interesting element that was never noticed before.
Sure. Antoine, what's your take on trends and flows?
Well, obviously, Olivier has covered many points. I look at the world in a slightly different manner. So
do you want a bit of water?
But if we're thinking about that, so yes, ETF industry has been positive, which is nice to be in that kind of trend that has been carrying on for the past 20 years. And usually, and that's one point that we should be making, so 50 billion, 55 billion, whatever in terms of flows, the proportion of equity flows is not that strong. If you're thinking about 45 billion going into equities versus the net amount of assets in equities, it's not huge, but it's positive. And there's one thing that those market conditions tell us, and we've been there in the past, in 2008, 2011, and 2018, and so on, is when the market is falling, investors go back to more index type of strategies, and ETFs tend to be the beneficial of those flows. So that's the first point. Second point, where have they been putting their money? Because that's also, I guess that you're managing assets for your clients, so you're thinking about the asset allocation. The biggest flows, and it might be due to a trend in some maybe model portfolios as well, is flows into global equities, MSCI Acqui, MSCI World type of strategies. Second biggest flow, the usual US equity. I think we've got S&P 500, and we had a nice presentation from Carlos. But the one that has been interesting to see, beyond being able to allocate with sectors across your portfolio, so think about energy, that's probably the only one that's been performing positively so far this year. The other one that's been interesting is dividend type of strategies. So in a market where you also need to rely on some other drivers of performance, dividend strategies have been pretty much plebiscited by investors in the equity space, whether it's US dividend or global dividend in particular. The aristocrats, as we say, so that's a very important point. In fixed income, the trend has been, as you said, a bit different. There is a real alternative today. Well, rates are going up, so you don't need to take any more duration. You don't need to take any more spread risk. And we've seen a big flow, and that's what we see both in ETF, but also through our kind of analysis of the broad market trends, so that we do through our different compasses that we publish quarterly. But the big trends is flows into US treasuries. Actually, interestingly, outflows from US inflation-linked or US tips in the ETF space. That's not what we see long-term investors doing. They're retrenching a little bit, but not as much. And flows into US investment-grade corporate bonds so far this year positive, but through the ESG lens. And I think that's the other trend that Olivier was mentioning. ESG is key. ESG is saving the year for many houses as well in terms of the flows. You're starting to see that kind of shift from active to passive, shift from non-ESG to ESG in the flow space. True. And I will leave you on commodities. Gold, precious metals, apologies, should have not been actually that kind of a defense type of strategy compared to other years. So that may come back later. But so far this year, the flows into commodities-based strategies have not been that strong. Maybe it was played before.
Well, going forward, Stefan, what about thematic ETF and the evolution of this segment of the ETF market? What's your opinion on this evolution? And what are the themes that are getting the most attention and that you pay the most attention to?
I think the thematic ETF market, or the thematics market in general, has three drivers to it. Number one, and I don't mean to contradict you, Antoine, but maybe the market is turning into something where people are not only looking for beta, but for advanced beta or a little bit of alpha in the asset allocation. So that's why thematics are becoming more and more prominent in the discussions we're having with clients. The second point is, I think we've all been touched by some of the themes around us, like inflation, you mentioned, central banks, which is a theme, but also the search for clean energy or energy alternatives. So it's something which is very close in our daily lives, and it probably moves into our investment decisions as well. And the third point is the proliferation of thematic ETFs. I think moving thematic ETFs from a niche product, not yet into mainstream, I think that would be a little bit over-exaggerating, but there's a lot of focus on thematic ETFs and the construction of the indices around thematic ETFs and the selection of themes to actually play. And you also asked what are the themes we're focusing on, and maybe it's also important to understand why we're focusing on these themes. It's number one, our research analysts select themes or define themes which are out there, which are relevant for all of our future. And then the second step, I think, is very important, especially in fund management and ETFs. In our case, are there enough equities around that theme? Because if you select a number of equities, you want it to be a selection, so that the universe has to be broad enough. So that's a limiting factor of which themes you can actually play. And then it's the definition of the value chain or the areas which define a theme, and then to have a theme purity by selecting these companies for the indices or for the ETFs. So I guess the themes we're looking at are the natural evolution from these discussions, which is clean energy, electric vehicles, future health, or cloud computing. So things that are in our daily lives, and then we all are trying to get means or produce means to invest in them.
Sure. Lucas, what's your take and DWS take on
I think we can only agree with this view. I would even position the thematic landscape even a little further in terms of where it is right now, because I mean, it's still, if we look at, for example, product launches, I think it's one of the dominant themes that we're seeing right now. I think in the UCITS space, there have been about 50 launches year to date alone, and there will be many more down the road. But what's also interesting, I think, about this trend, and that's what makes the thematic space kind of unique, is that, of course, the topics themselves, they are in many ways very client-driven, and very trend-driven as well. So that's definitely, I think, unique for the thematic space. So, I mean, so my background is in product development, and let's say for ESG, we try to anticipate kind of the themes 1, 2, 3 years down the road. But in the thematic space, that's not really possible because the themes evolve very quickly, and there's basically client demand that can come from one month to the next one. I mean, let's just pick one example, genomics, for example. So we launched that as a product now, but it wasn't on the radar before COVID, really. But then basically because some of these technologies have been very instrumental in actually developing a vaccine, developing rapid tests, there's all of a sudden interest for that, and then a product is created on the back of that. So that's one, I think, important development that we're seeing, and that can really move this space very, very quickly in the entire ETF landscape. And the other development we're seeing is that, of course, the investor use cases are slightly broadening because themes are actually maturing across time. So if we look at a theme that's been around for a bit now, like future mobility, for example, there's been, I mean, a lot of talk about this for at least the last 5 years in the ETF space, 10 years in the industry or so. And that theme matured also when it comes to the investors that use it. So the factor footprint of that exposure changed undoubtedly. So you're moving more into kind of like a broader benchmark allocation, much less of a growth orientation, less momentum orientation, and it suddenly becomes investable actually for investors that are looking also for like a broader portfolio building block. So that transition into kind of the strategic allocation bucket is definitely something we're seeing. And if you look at the flow picture for thematics, I think that perfectly proves this trend. I think I've seen relatively stable flows across the year. I think the thematics category is still up 3.5 billion in usage or so on the year. So very persistent demand that really points to these more strategic use cases as well in the space.
Sure, interesting. Well, Chris, going forward into the role of ETF in portfolios, let's say, what's your take on the role of ETF in discretionary portfolio management? And also maybe a second question, do you find that the clarification of independent versus non-independent advisory with the recent regulation gave a boost to the ETF market some way?
Yeah, so I guess first of all, thank you for inviting me to speak. I would certainly say, you know, you've heard of the smorgasbord of ETF options that are out there, whether it's equities in core beta exposures, whether it's thematics, whether it's fixed income. You know, ETFs are a tool that offer the ability for asset managers to allocate efficiently across whatever range of options they're looking for, and there are literally thousands of options to choose from, and you know, you can see up here a wide range of providers available to offer them as well. So there's a very strong competition, which means that, you know, I think what everyone focuses on in the ETF space is low cost, efficiency, transparency of exposure means that they make very effective tools for those asset managers, whether it's, as I say, a core building block, offering, you know, outperformance versus, you know, the standard market indices in some cases, or whether it's perhaps a more idiosyncratic or interesting thematic satellite type strategy, whatever it is, there's that option out there. In terms of regulation, I think regulation does have a big impact, and I think what you've seen is changing regulation across Europe has had a big impact on demand for ETFs. So if you, to take a previous example of changes in regulation, the sort of unbundling of payments to advisors in the UK, which happened almost a decade ago, had a massive impact. Suddenly, retrocession payments are not allowed, and you start to pick strategies because the strategy makes sense, not necessarily because it's part of your business model.
Sure.
So I think that, you know, sorry, I have to be careful how I put this, but you know, it's what's in the best interest of the client at the end of the day, and low cost and efficient exposure reproduction is the way to do it, as highlighted by our first speaker today as well.
Sure. Peter, how much do you agree with Chris?
Very much so. But maybe taking one step back and looking at regulation, and what it has done really is that MiFID, and in a post-MiFID world, clients and especially banks, they pivoted in two areas. One is the execution only, and the other one is the DPM, so the portfolios, so to speak. You see that most pronounced and at various speeds in Europe, but most pronounced in the Netherlands. We've seen it in the UK, also Switzerland. And there really DPM is the name of the game. And ETFs fit perfectly as low-cost engines to drive those central propositions that are driven out of the CIO offices in a very consistent and very efficient ways. And why do they fit so perfectly? Because they're very efficient tools. 90% plus of the performance comes actually from the right asset allocation. They give you diversification with just one trade. They're very convenient, and as we've heard, they're widely available and available in a very granular fashion. So all of that, plus cost, which is also a very important factor, really help driving and power those DPM propositions. And the cost part, I think, is a particular good one, because particularly in fixed income space, you can access with one single trade hundreds and thousands of different bonds. So the round trip and the total cost of ownership, as we call it, is very low and makes it very efficient tools. And even the biggest DPMs across Europe are using more and more fixed income ETFs. We've seen that in our range 2 weeks ago, and we've seen the biggest trade in fixed income ETFs that we've ever seen, 700 million into short duration corporate bonds, which was one large DPM that could also have accessed the bonds directly, but they consciously went for the ETF because it's just so efficient. And as we also see technology evolve and see like digital DPMs come up more and more, they also almost exclusively use ETFs because they're so efficient, and the DNA of an ETF fits perfectly into those propositions.
Yeah. And staying with you, and Antoine talked about ESG as the savior of the flows. But do you find that clients in this market scenario, do you find that clients are pushing ESG more to the bottom shelf now and focusing on other kind of criteria and products?
No, I don't think so. Really, what happens right now is basically the green transition is just at the beginning. So we see a lot of flows and a big responsibility also of the asset management industry to fund that green transition, basically, be it in the interim, but also the very long-term projects. And if you look at the ETFs, there's like 3 observations. One is the transition is happening faster as we would have expected. If you look at iShares, for example, this year, 53% of overall flows went into ESG products. So that is actually faster than we would have expected. Drivers for that is one, regulation, so top down, but also bottom up, the consumer demand. We see that, for example, from online banks, which is pure execution only, that these end investors, these retail investors, they more and more also pivot towards ESG ETFs. Before the pandemic, basically, we've seen about 3 to 5% of the assets and the flows go into these ETFs. Now it's more towards 25%. So you see that demand, and also what we see is that the net zero transition is real and is happening. And the last point is that the flows in ESG, despite the market environment, despite the Ukraine and the rising interest rates, and also a year where the standard indices in general outperform the ESG indices because of the skyrocketing oil and gas prices, we still see that the flows are very, very resilient and very stable in nature. And actually during the Ukraine crisis, at least for our iShares range, we've seen that flows in ESG are more stable than for standard indices.
Sure. Well, Stefan, I'll jump to you. I'd like to have your take on the ESG role in your client minds.
There's nothing to disagree, which makes the discussion a little bit less lively, as it were, if I could disagree. Maybe a couple of things to add. So yes, I do agree. ESG is a trend that has been here for a few years. It's different across various countries in Europe. I think there's a Europe of different speeds in terms of ESG, but the direction is definitely towards ESG. And as Carlos mentioned in his part, ESG is an evolution. It's a journey we're taking with our clients. And we're in a development phase, and I think we're going towards the phase where clients are thinking not about what to do with their money, but what the money then does, because we're investing on behalf of our clients in the end with the ETFs. And another thing that came to mind when listening to Peter, I feel like the ETF market, it's not young anymore. I think the first ETFs, again, as Carlos mentioned, have been listed over 20 years ago. But still, the market keeps getting challenged. I remember 2 years ago, in the March of 2020, the big first corona-driven sell-off, there was a big discussion around fixed income ETFs. Are they efficient? Are they better or worse than mutual funds? And what's the worth of an NAV? And this discussion. A few months later, everyone realized ETFs are the more efficient instruments in fixed income. And to me, if we look at the flows at the beginning of the year, I think it's at one point energy sectors, or the energy sector was very firmly embedded in the top 10 flows in ETFs. And that's not necessarily an ESG index. So at that point, clients were, or investors were thinking where to make money, because that is their fiduciary duty to make money for their investors. But after a few months, the ESG, the strong ESG current underneath that, trumped that. And if you look at the flow since the beginning of the year, ESG is the main driver of flow. So I do agree, and maybe there's a few arguments to add to that.
Cool. Chris, what about the evolution of sustainable ETFs? How do you see the recent evolution, and where do you expect it to evolve?
Yeah, well, I think first of all, Stefan put it very well. This is an evolving space. We're working with our clients to deliver the solutions that they want to meet their sustainability needs. And I think ESG has evolved hugely even over the last 5 years. And you can think of it sort of almost like the adoption curve in technology. The true believers, the early adopters in ESG were very much, very green focused, very strong in their beliefs, and that was reflected in the sort of ESG products that they were investing in. So SRI indices, very dark green, very exclusionary, very interventionist in portfolio construction terms. What we've seen since then is, I think, a broadening out of the sustainable investor base. We're now moving from the early adopters into the sort of the more mainstream, and actually there's a much wider group of opinions over what sustainable means to each of those different investor groups. And that's introduced, I guess you'd say lighter green, lower tracking error products that have still meaningful intervention, that meets a different need for a different type of investor. Obviously, we've already heard from our earlier speaker talking about climate. I think very much ESG has focused on the E so far, and perhaps the G, which is relatively easy to measure as an index provider or an asset manager. And climate has obviously been a key focus. There's a huge swathe of products now out there tracking Paris-aligned benchmarks, for example. Going forward, though, I think we'll continue to see an evolution there. And perhaps I think the biggest evolution is going to be in the S space. So, having focused on E and G, which are the low-hanging fruits, as it were, for these types of portfolios, I think S is going to come increasingly into focus. There are a few products out there, typically tracking, taking approach to gender equality, for example. But that's just the tip of the iceberg for the social side. I can see a lot of products coming through that are likely to impact that area significantly.
Olivier, what's your opinion on the future of sustainable ETF?
Well, a lot has been said already. So maybe once again, I'm glad there's no disclaimer, because I may be a bit controversial on this one. So, for me, there's clearly a natural evolution of the ETF industry and the ESG market overall, as you've said. I think this is undeniable. There's lots of gaps in the industry, and I think us as ETF providers are also playing catch up on this. And this is based on client demand, but this is also based on the investment capabilities. I think there's hundreds, if not thousands, of ETFs around the globe offering ESG exposures and capabilities and investment strategies. The difficulty is to adapt at the right time. So you guys in this room are quite lucky. There's lots of ETFs out there. But also, in my view, to scratch our head as asset managers, first and foremost, and it is our fiduciary duty, first and foremost again, to offer you the best of what can be available out there. We've chosen, at J.P. Morgan, this is one of the ways to offer this, to not only offer ESG ETFs through, I would say, tracking indices, but also used indices as benchmarks, and apply and embed within our own analysis with our analysts the the ESG criteria, the E, the S, and the G that you were talking about, making sure that we could address not only the climate change, but all of the ESG matters. I'll give you one example. We've deployed a range of ETFs that are called Research Enhanced Index. They're tilted ETFs, if you will, tilted performance ETFs. And the idea is not only to deliver a slight outperformance, but to embed fully the ESG exclusions, inclusions, but also the engagement that you can expect from an asset manager, because we have, as ETF providers, in my view, a fiduciary role to protect your assets, but also to manage your assets in the way that you want. So there's a way to make a difference in those examples. One concrete one, because I know this can be very theoretical. I would, and you know, this is public information. John Deere, I don't know if you know the truck company or the tractor company in the US. If you look at it from a pure, I would say, agnostic angle, they do pollute a lot with their tractor companies. Of course, they build tractors and they use gasoline and they pollute. But if you look at the way they've been investing in their research and development, to give you one example, they have put massive R&D into cameras that are built on the trucks that they build for crop and anything that's related to field crops. And they have managed to deploy a way to identify the spots on the field that need pesticide or chemicals or anything that's needed to help the crop grow better, instead of just spreading it out the entire crop field. It's one example of when you have a second reading where you can make a difference and where, in the end, you can pollute less. So one example.
Very interesting. Lucas, going further than climate, what other themes in the sustainable space do you find that are out there? What are clients demanding?
I think that there's certainly opportunities to develop this space even broader the next couple of months. I think because you referenced that climate topic, if we look at that, I think the success, for example, behind the PAB demand that we're seeing right now, this is pretty much different puzzle pieces coming together, right? On the one hand side, you have quite an innovative approach at investing that is really educating also clients and investors overall, right? Because this is a broad shift from basically ESG just being this race to the bottom where you have to apply SRI filters and become ever more exclusive. It's completely changing the name of the game, really, because we are now looking into engagement, and all of a sudden, this is on the agenda also for passive funds. And then you match this up with a lot of, let's call it regulatory certainty around these concepts, right? So this is a clearly established label, there's regulation around it, and investors feel confident with this at the moment. And so when it comes to the growth opportunities, I feel for topics such as this, these are exactly the two pieces that are actually needed. So you need a new approach, and there needs to be kind of a robust framework already now that you don't have to, say, reclassify a product down the road. That's a key risk for investors, I feel. So where we see these opportunities are, for example, in the green bond space, but also more broadly in the social and sustainable bond space, because you have, again, a new perspective to really look at a topic. Like here, we're completely switching the view from your fixed income ESG approaches that, again, look at the issuer. Rather now we're looking at the single bond level, and we're very much impact orientated in what we do, because this is now just the use of proceeds that play a role, and we only introduce minimum safeguards really on the issuer. And you match that up again with kind of like a clear label. So on green bonds, I think a lot of work has been done by the Climate Bond Initiative, etc., to really establish this. The EU is doing more. So again, together, these two pieces then can really drive demand. And the space is expanding so rapidly that it can actually go beyond many of these climate topics. So yes, the majority of the issuance amounts right now, they sit in green bonds, yeah. But social bonds, for example, are massive, and they're catching up quickly. So in the year of when the pandemic first hit, for example, social bond issuance was actually much larger than green bond issuance. So the market is turning and really allows to address a lot more topics than just green transition, but also broader social topics.
Antoine, how are you viewing sustainability further from climate? No?
Yeah, well, so first I'm very touched by green bonds because I started with the climate bond initiatives and the IFC back in 2009, 2010, when the market was a 50 billion market, which was not ETF-able at the time, but we were thinking about that already. I mean, there's a number of trends. I think one of the points which, and if you allow me to go back to what is driving that trend as well, is the classification. The certainty of classification is important. You mentioned climate. There's been a lot of Paris aligned or climate transition benchmarks, depending on the ones which have been going out. But there is an uncertainty, and I think we're getting close to the end of the month, where maybe there's going to be more reclassification of Article 9 funds to Article 8 funds. But this is something that is important as well. So regulation is a big driver of those flows. Whether you want an Article 9 fund to put in your fund of fund, or you want an Article 8 fund, because maybe you don't meet all the taxonomy that qualifies or that defines what a sustainable investment is. And to your point, green bonds is definitely a sustainable investment. It's got, it's got a target. Well, normally, if it's not greenwashing and you've done your due diligence, and the climate bond initiative as well has agreed with you. Same thing for sustainable bonds. But the rest is a bit more murky. It's not very clear, and as a result, you've got to be careful in terms of what you're offering and understanding what the investor need is. The trend is about climate, and it's claiming, obviously, reducing CO2 emissions. Paris-aligned benchmarks are defined by the EU, and as a result, some index providers have created their version of that. But again, there's a million ways to cut it and to define a product. So this is going beyond that, and then you've got investors who also say, okay, what a benchmark is. Benchmark is defining the way the economy is being funded, with its good and with its bad, with the trends. And so I want to be performing in line with the global economy or with that part of the economy, but I want to do it better. And I'm going to try and minimize tracking error, put some constraints where I need. But if I were to copy what Carlos has been putting in his slides, we remember divest, integrate, and accelerate. Accelerate, the best in class, can be also a way to do it within that capsule of constraints, and that's a very important thing as well. That's where we saw flows from our side, especially in the investment-grade corporate bonds, not Article 9, Article 8, but you're doing better, trying to integrate all those dimensions, whether it's polluting less or putting less chemicals in the fields and still having a good productivity, or having a better governance, or having a better environmental element. So this is going to continue. The challenge for you investors will be to choose from all those topics. And whether it's about defining the way sometimes you look at it because of a TR, maybe not the way you should start. You should start from the universe, but then looking at the drawdown, risk-adjusted return, and you add a new dimension or a few new dimensions in terms of this reporting on ESG, which are going to be even more important going forward. It's just a journey, as you said. We're at the beginning, but we can see that in terms of flows, this is steady as she goes, and you were talking about Euro Corporate, and I think the flow was in SRI fund. If you're looking at the flows on Euro Corporate so far this year, just outflows from the non-ESG funds, inflows into the ESG funds. In total, it's positive. And it's been positive not so long ago, actually.
Well, in going further into fixed income, Olivier, how can ETF, fixed income ETF?
I've got the ETF, the fixed income expert next to me. So,
what kind of strategies and how can fixed income ETFs work as a tool for asset managers and allocators to manage duration and play with that?
Oh yeah, especially over the past 2 months, quite an interesting topic. Yes, I would say once again, you all in this room are very lucky because there's a myriad of ETFs out there who enable you basically to do a couple of things. Either choose your entry point where you decide to go on the curve. So how long do you want to be? That's the first question, and there's tons of, I would say, indexed or passive ETFs out there. And then you can pick and choose if you're an asset allocator or a fund manager, what suits you best. And in that case, as you said, some of you will look at the cost, the efficiency, the tradability. I think there's enough competition in that space to really find what you want. So an entry point is always the key to access this. The second part is the investment style. And I think this is where the market is making a difference as well in the ETF space. One of the largest, I would say, categories this year in particular has been the ultra short duration type. So a little bit above the money market, if you will. So just going a little bit, getting that tilt. So reducing the duration of your portfolio, but still trying to find some ways to manage your cash and be as efficient as possible on those exposures. And there's a myriad of products. We have deployed as well ultra short duration active capabilities. And to give you one example where the entry point doesn't matter anymore, but the style matters, is that we have portfolio managers, expert portfolio managers who manage trillions of dollars in that space, in that category, and who will make, through the ETF wrapper, their expertise available to even reduce even more the duration in the portfolio. I think the duration is now 0.1 year in a Euro corporate portfolio called Jest. And you can only get that through the active management style. And I think that makes a big difference. You can reduce your risk, of course, doing this, and then you can implement a different strategy while you're invested into those types of ETFs. So a myriad of products offering you what you can need, an entry point or an investment style. That's what I would say.
Sure. Stefan, how much are you seeing clients adding duration and exposure to fixed income after this earthquake that brought up yields and coupons and?
Well, I would say it has started. I don't think we're where we want the market to be yet. And there's two reasons why it has started. Number one is yield. All of a sudden there is such a thing called yield, and it's not zero, which is very important for fixed income investors. And the other thing that comes with the yield and with the movement in fixed income is you can diversify your portfolio, because the diversification effect of bonds was all but non-existent a few months ago. So these two things, coupons, yields, and diversification, has started to lead investors towards fixed income. But I don't think they're where they want to be yet, because they're a little bit afraid, and I feel with them and with all of us, because is inflation transitory? If you look at what the Fed has said over the last quarters, it started with, there's no inflation. It's actually transitory. Actually, it's not transitory, it's here to stay. We don't need to hike, we need to hike more. So I think as long as there's no stabilization in the ecosystem of central banks globally, clients will start to venture into fixed income or back into fixed income, but they're not going all in yet. And I think that's very prudent not to go all in. But once there's stability in fixed income and you have a certain amount of yield and the diversification, I think there's a huge trend towards fixed income. And looking back at what Olivier said in his very first part, the flows have been very equity heavy this year. Yeah. And there's a need for education, or I think education is the right word, for all participants in the fixed income ETF side. How is the index built? Is it market weighted? Is it credit quality weighted? What's the duration adjusted spread? All those kind of things. And it's easier on the equity side, because indexing has been around in equities, it feels like forever. Whereas in fixed income, there's no go-to index per se. I mean, yes, there are niches where there's index provider who have established themselves as the go-to somehow. But I think that it's a journey like ESG. And to me, it's an underlying trend similar to ESG, that fixed income will become a bigger part of the ETF portfolios of our clients.
Sure. Antoine, what about credit risk, and namely, specifically default risk? That's usually a big argument for.
That's maybe why he's just a bit careful about not getting back into it.
How do you face that in the ETF world?
I'm just going to take my strategy hat, but there's a few things. I think it comes back in terms of the way we're designing products, whether you manage it actively or you track an index. What is the index? How is it working? How is it defined? Is it diversified enough? Do you have caps if you're going into high yield? Do you try to manage, with a minimum rating and so on? Credit default could increase. I mean, economic situation is not necessarily the greatest. You said that central banks are going. No, only one way to kind of get out of inflation is to punch demand, and that is not always very good for everything. So yes, US economic numbers are better, but if you look at European numbers, we're just in a recession, I'd say. It's fair to say, and it could be even worse. So you're going to have to look at that kind of dimension of credit default. Default risk in investment grade, historically speaking, hasn't been massive, apart from fraud, Parmalat, Enron, whatever. But straight default into investment grade corporate is not huge. So you're going to see that negative migration. You're going to see, triple Bs being downgraded to double Bs and so on. They would get out of the benchmark, and you manage that when you're an index tracking manager or even an active manager. You manage that around month-end rebalancing, a little bit before, a little bit after, depending on the tolerance of risk you've got. If you're replicating physically, if you do a swap, it's different. The swap does it for you. It tracks the index and you pay for the premium. But if you manage the bonds and you've got to buy that, you're going to be careful about that. So I'd say the first thing, if you're worried about defaults, is just make sure that you enter at a level where spreads do actually reflect enough pain in the market or enough protection from a default standpoint. And then the index tracking strategy is going to kind of model through that. When it's about high yield, maybe hard currency, emerging markets, and so on, then comes the question about how do you build your index? Do you have a cap? Do you have a minimum rating so that you don't have to deal with outright defaults or with bonds that have defaulted and stay in the index, like Lebanon in some hard currency indices? So that's where you've got to be careful. Usually, and I speak for us here, we've managed to go through that in a fairly good way because we've got strategies. So obviously, it's very risk managed. I'd say that first and foremost, we are risk managers, but we've got the difference between us and the risk manager is we're confronted to the reality of having to trade and finding a price on the bonds. But this is how we do it. And we've managed to go through many, many crises, and that comes back to the usage of ETFs and the BIS paper that you were referencing back into in April 2020, subsequent paper afterwards. But even, I would say, if I would point you to the usage and increased usage of ETFs, whether you've got credit risk or not, you always have credit risk. But whether you manage credit risk well or not, is this structure has been tried and tested. There is a way to make the market, and even the IMF paper that was released a couple of weeks ago, chapter 3, page 36, you have a nice graph that can tell you everything about that. And that is showing that ETFs have a role to play in fixed income portfolio management, whether you buy it for liquidity, for exposure standpoint, or for the management of even risk, because you don't know what your active manager may be doing. It might be over-concentrated in one bond. Yeah. I don't know, Steinhoff in converts, all this kind of stuff, and boom, you've lost more than the benchmark.
Well, Chris, what's your take on default risk and credit risk?
Yeah, so I guess first of all, the key thing, as I guess Antoine has already said, is choice of benchmark is what's going to determine the amount of credit risk you're taking. So whether you're in high yield or investment grade or all the way down into government debt. So if you're concerned about default risk, then obviously moving out of high yield and into investment grade, and investment grade looks reasonably attractive in the current environment. Or if you're particularly concerned, then obviously going all the way to treasuries. I think it is worth saying that the role of the portfolio manager, even in a passive product, can make a big difference as well. So, most physical fixed income portfolios are using sampling. So our portfolio managers do have the flexibility if there's a particular issue that, has a problem or a higher credit risk than you're happy to bear. You don't have to hold that in your portfolio as long as you're controlling all the other risks around the benchmark exposure. The other thing you can do, of course, is to look at perhaps some more interesting strategies within fixed income. So, and again, Antoine's already mentioned the idea of companies seeing their debt downgraded from investment grade to high yield. We actually manage a high yield Fallen Angels fund that takes advantage of the structural anomaly that causes. So when a company is in an investment grade portfolio, gets downgraded too far, drops out of the index, vast swathes of investment grade managers are having to sell that because they can no longer hold it under their mandate. And it artificially depresses the price of that bond. So typically, if you're buying companies as they drop out, effectively you're providing liquidity and you're being rewarded for doing that because they tend to bounce back. Obviously, some of them don't, but on average, across the whole portfolio, you tend to do reasonably well out of that type of strategy. The other thing I'd say around credit risk is, you can also look for other sources of return. So another good example is AT1s, for example, so CoCo bonds from banks. They tend to trade at a much higher yield than you would get on the bank's standard, senior debt, because there is a subordination risk there. But ultimately, you're being rewarded for that subordination risk, because what is the risk that the bank that's issuing that debt is going to go bankrupt and convert that to equity at the worst possible time for you as an investor? You're getting high quality investment grade companies, but you're holding a more subordinated debt exposure and being rewarded for doing so. And I think recently the yield on our AT1s product went past 10%. So, you're being rewarded reasonably well for that risk.
Lucas, what's your opinion on ETF as an alternative to bonds?
I think we briefly spoke about it already, right? But I think so far the focus has always been in this discussion on really presenting the ETF as a good vehicle in times of crisis. And I think we're a little bit all guilty of that whenever there's a crisis, like every provider puts out a study on basically how fixed income ETFs are, at the end of the day, a price-finding instrument in a lot of illiquid markets. But once we return to normal operating environments, the discussion dies down a little. And there's actually, I think, a lot of storytelling that is still needed around the fixed income ETFs that can really position them, especially with institutional investors, for example, in a very, very different light. Because at the end of the day, these fixed income ETFs, and they are what we would call kind of a buy and maintain investment, right? You have a lot of automated mechanics that work on these fixed income ETFs, and many of those are actually underappreciated by clients, I believe. So if you look at a space like Euro corporates, I think that's where it really comes together. You have a super broad index, 3,000 bonds or so that you can buy. The maintenance element here is actually quite significant. So you would have, for example, with your kind of monthly changes in the index, that's typically 150 bond trades or so that you would need to do every single month if you were to track that index yourself. So the passive PMs can really alleviate a lot of that monthly rebalancing stress. When it comes to, just investing, when we see that preference now to shorter duration, just every month recalibrating your duration and being in a fixed point is a huge value add. And then I think these fixed income ETFs are even entering what we would call almost active territory in some extent now. So on our side, for example, our PMs are within their risk limits, of course, engaging in new issuances. So that's typically what many of the proponents of kind of self-managed fixed income single bond portfolios would hold out, is that, well, intra-month we can take part in new issuances. It's not that the ETF doesn't do it. The ETF has some tracking error budget, of course, and within that budget they can basically already invest in a bond intra-month if they have, and the index methodologies, the way they are constructed, give this certainty. You know the bond is going to enter the index the end of the month, so why not invest on the day of the issuance and basically pick this new issuance premium? So there are a lot of elements that come together, and it's somewhat underappreciated, especially I feel in the corporate space. There's a strong element, and then if we take it to the extreme, then of course in the high yield space even more so. If you look at the way fixed income ETFs are created and redeemed, the underlying liquidity of many of these bonds that are traded there is weak, right? You've got high yield bonds that only trade maybe once a day, if at all. And then you have the fixed income instrument, which trades 100 times a day. So this is hugely different types of liquidity, and especially in the corporate element, there's no way around it.
Sure. Peter, I'd like your opinion on that, but also we've seen, after a long time, a new target date bond fund being born in Portugal. And we find that target date ETFs could be a thing?
Yeah, well, first of all, I agree, and a lot has been said. I think it's worthwhile to also talk about why bond ETFs have been so successful over time. They were pioneered, as we said, 20 years ago, and kind of grew decently over time. It was the less complex products, like government bonds, for example. But then with the financial crisis, when it hit, that was a proof point also for bonds, because the banks had to pull out as liquidity providers for single bonds, right? because they had to reduce their balance sheet by 30 or 50%. So that was actually the kickstart for the more like complex products like corporate bonds, high yield bond ETFs. And that accelerated the business massively. And then, as has been said in the current or last crisis, the pandemic, that was the ultimate proof point for bond ETFs, because we've seen a lot of critics who have said, if volatility hits, those products are not going to work anymore. But that was the ultimate proof point. We've seen the ultimate volatility, and those products work brilliantly in terms of price discovery tools. And from there, we're only accelerating. Saying that, looking into the future, I think there's more space for product innovation, be more granular, be more like with ESG flavors, for example. And then to your point, I think we also have to appreciate that bond ETFs do not work for all types of institutional investors. If, for example, you look at an insurance company on their balance sheet, those products, they look like bond ETFs, but actually they're accounted as equity. So they basically hit the P&L of these insurance companies. So I think there's a space for target date ETFs in the future that look and feel like a bond, are treated like a bond from an accounting perspective, but have all the benefits of an ETF in terms of diversification and also liquidity. And I think that is one space we're looking to pioneer as well for ETFs.
Amazing. And since you talk about institutional investors and their positioning, how do you see institutional investors positioning in ETF?
Yeah. So interesting enough, if you look, like ETFs actually came from the States, but actually the first flows we've seen in the States were all from retail investors. So it was really a retail product, and institutional followed. In Europe, 20 years ago, it was the other way around. Institutional investors embraced ETFs, first the first equity ETFs, for example, to manage the equity quota, very simple products, but it was actually institutional investors who embraced ETFs here in Europe. That has changed in terms of like a more diversified client base, from wealth and retail, from end clients as well. So really a diversified client base. But institutional investors are still very dominant and are really embracing ETFs. Also because over time the management fees have come down, the products have gone bigger, they actually have become financial instruments. If you look at corporate bond ETFs, for example, and have really become an institutional product that trade at a very tight spread. And I think the end game for those spreads is something like you see in the States. The high yield ETF in the States trades at 1 basis point only. So it's really an institutional product and competes with index mutual funds and also mandates, because actually the liquidity and the flexibility you have with the ETF, that almost comes for free on top, that secondary market liquidity. And then all the use cases we discussed for portfolios, for DPM, also apply for institutional investors. They obviously have to manage their asset allocation. There's additional use cases, for example, that shift from defined benefit to defined contribution. There's a big space for ETFs. We've talked about the target date ETFs at some point, but also other use cases like liquidity sleeves, for example, which is more important, I think, than ever before during those times. We've seen what happened in the UK with the LDI portfolios just recently. I think there's really a case there to have liquidity buffers in the portfolio to be able to manage the portfolio better if really some incident hits or some crisis hits. And we've seen that in the UK, and I think the learning from is to really use more ETFs in those institutional portfolio.
Cool. Antoine?
No, I was going to say there's a great survey we did, which is in your bags, about the use cases of fixed income ETFs. How institutional investors are going to use more and more fixed income ETFs going forward. And as we were talking about ESG, there's one data point which is interesting among your community, is that more than 50% of the people we surveyed across the world plan on adding ESG through fixed income ESG ETFs in their portfolios within the next 12 months. So we're all here.
And what about institutional investors' position in ETFs? How are you seeing that?
So I mean, to your point, Peter, it's, the US started with more retail, and that was also driven by regulation. It's a tax element that kind of propped the ETF market in the US first. Now they see the usage beyond the tax element, and the large institutional investors in the US are starting to go there. I think we can go now close to 50-50 in terms of who's using ETFs in general, but fixed income ETFs in particular in the US. And in Europe, I'd say that for us, I mean, I consider everyone in the room as institutional investors in a way, because you manage as big pools of assets for others. I think it's around 80% or more who take fixed income ETFs as a tool. Usually, they would tend to use those fixed income ETFs in the kind of more satellite types of exposure, so EM, high yield, the places which are sometimes difficult to access, whether it's but opening an account in China bonds, for example, or in maybe Indian bonds whenever they come into the benchmarks. But these are the kind of things which are first the first port of entry, and now it's diversifying a lot more across even govies to some extent. So for kind of quick adjustments, whether for a duration bucket, we're talking about ultra short or some parts of the curve. And then, as we've seen some very large investors buy, the broad index, global ag, or others in their portfolio. I think that there's DB, which is defined, so which has a target date. So sometimes the target date could be helpful. It's more complex to manufacture because the closer you get to the end, the less liquidity you might also find. But overall, it's interesting. But DCs, I mean, they're going to use Euro Ag, Global Ag, and all those kind of flavors. And they've just you can buy it for €10. Well, if you buy 1 unit. And you got a good broker, but it's or €30 depending on the prices. But it's so that's really easy, and everybody can do that. So the trend is there. Afterwards, when you think about the positioning of of institutional investors beyond ETFs, what they've been doing recently is pretty clear. They've gone they've climbed up the hill. Obviously, the hill of yields. As yields have gone higher, U.S. Treasury yields in particular, we've seen across our data print, which is around 15% of the total assets in fixed income in the world. It's not us managing; it's the custody bank. Okay, it's just but it still is around $12 trillion of assets, and we've seen investors buy massively U.S. Treasuries, and actually starting to buy the long end. So, first message: they seem to be pretty sure that inflation will remain in check, because you wouldn't buy kind of something with a duration of 18 or 20, which kind of the volatility of an equity portfolio, if you were unsure this would work. And the second point is they've been extremely risk averse, selling high yield, maybe a little bit less than at the end of the second quarter, but still very much on the selling side, selling investment grade corporate, and a little bit of light in this kind of, it's very sunny outside, but in these gloomy kind of markets, they've been buying Euro investment grade corporate through ETFs, but also in the overall portfolio, because maybe COCOs are attractive, but investment grade corporate Euros is attractive as well at this moment, and it's better priced from a default risk versus US investment grade to some extent, if you're trying to play it, relatively speaking. So this is a trend, and we can observe that a little bit through the ETF flows as well, which do tend to mimic that. So US Treasuries, a lot of inflows, and a lot of outflows from some slightly more exotic type of exposures. I'm not going to take a punt on Chinese bonds, because there's many reasons for outflows from Chinese bond. The first one is, oh, by the way, now I have an account and I can buy the bonds directly instead of using an ETF. But that's
okay. Olivier, how do you bring active management to ETF? ETF is known for its passive side. How do you bring the active management to these kind of products? And how do you overcome the operational challenges that arise from that?
So that's a good question, because when we decided to launch ETFs at JP Morgan, we really wanted to offer the whole palette of products, not just index tracking, which we do have, but going to the smart beta, as many ETF providers, up to the full active capabilities. The one thing I would say is that ETFs is just a wrapper. That's something that is, I think, well known for now, but maybe in 10 years we'll be calling FundsPeople ETFs people. It's just a wrapper, keeping the efficiencies. And I would say, back to your point around the development of the ETFs in the US, in Europe in particular, all ETFs with no exceptions are UCITS compliant, which gives you a certain level of comfort in terms of diversification, liquidity, and reporting obligations. The hurdle when you launch an actively managed ETF is around the transparency of your portfolio. So do you want to give out basically your recipe? Do you want to give out your tricks? Do you want to give out your insights? And so it depends on the level of comfort as well of the asset manager you're choosing, your ETF provider or your ETF providers. What we've decided to do is really to go full transparency on what we're doing in Europe. So anything that we provide either on fixed income portfolios or equity portfolios or multi-asset solutions portfolios are fully transparent. And I would say there is no particular hurdle or drawbacks in terms of operational obligations. We have the same registration, same obligations in terms of listings. We have market makers as well, exactly in the same way. They do get the full transparency of their portfolio every single morning, the jargoning term, perfect basket. Every single morning we provide that. And you can buy those actively managed ETFs in the same way with the same brokers, same intermediaries than you would buy an index tracking ETF. So ultimately, I would say UCITS, the UCITS label almost, is a great catalyzer for many investment ideas beyond pure passive or indexing capabilities. The one thing I would say as well is that as long as, we speak with many clients, of course, across Europe, and we see a certain level of comfort, of course, with professional investors, institutional investors that we were talking about, asset managers, but there's also a more retail form of a sort of democratization, if you will, of the ETF usage. And we see the use of actively managed ETFs with retail investors as well, deep retail investors, platforms. I know in Spain we've got the traspasable, which makes it harder, but very, very well known. But I would say in other jurisdictions across Europe and actually outside of Europe, because UCITS is the reference outside of Europe, except for the US, I would say ETFs are being democratized, which is very nice to see from an investment standpoint, but also for your standpoint, because I do believe this is the future of the industry itself.
Well, Stephen, just as JP Morgan, Fidelity is known for the active management. How does Fidelity go into ETF?
Before stating what our ETFs are, I'd like to also state what they're not, because Peter mentioned a lot of things come from the US, especially in ETFs, but the UCITS ETFs are not your unconstrained active fund just put into an ETF wrapper. Currently, that's not allowed under UCITS, and I think and that's my personal view, I think it's the right thing, because ETFs, we've talked about transparency, we talked about liquidity, but I want to talk about market access and the use case for an ETF, because the ETF, the basic idea in my view is you buy a very well-defined part of the market. So it's a bit like, some of you might remember, what you see is what you get. If you want to buy a global equity portfolio, you want to know that is a global equity portfolio. So coming to what are our active ETFs, they are not the Fidelity active funds just wrapped in an ETF. It's a clearly defined range of products to help you or to enable you to invest into global equities, US equities, or European equities with the active approach on a company level. So the alpha we're generating is not from sector bets or country bets. It's only driven by company selection. And it's also driven by the engagement we have with our investee companies on the ESG side. So you get the Fidelity DNA which my colleagues don't necessarily like me saying it, in a constrained way, just to make sure you get what you want in the ETF. So I totally agree with Olivier. There's nothing different to these ETFs in an operational view, in a tradability point of view. You have all the ecosystem, you use all the ecosystem as in classic passive ETFs. It's just another evolution in the ETF market to enable clients to choose whether that's what they want, but above and beyond the pure indexing.
Sure. Chris, what about ETF as a way to get exposure to commodities, namely energy? How are you?
Yeah, so it's been quite a theme this year, has been the commodity move, obviously, and it's interesting when talking about the broad market flows earlier. The overall flows for commodity are basically flat year to date, but that's a very it's always the devil in the detail. It's a journey of very strong inflows in the first half and very strong, reasonably strong outflows in the second half, as we've seen profit taking from those clients who have gone into those trades. Take a step back. Obviously, energy things like energy sector ETFs or some more specialist products like MLPs have seen saw very strong inflows in the first half of the year. But also broad commodity products, things like just a simple BCom, the Bloomberg Commodity Index, or BCom X-Ags product, which provides a more sort of a greater exposure to energy, but still in a diversified portfolio. All saw significant activity in the first half, and then as we've talked about, the ETF is a tool that provides liquidity and allows investors to move their money as they require. We've seen again an unwinding in a lot of those positions as they've taken profits and started to wonder whether commodity prices can continue to double and double and double again. Obviously a very unlikely scenario. The other area is gold, which we have a very large stake in, as it were, with the largest commodity of gold ETC in Europe. And that's been another interesting area. I think middle of the year we had something like $1.5 billion of inflows into our gold ETC. We've seen some profit, some outflows as gold did very well during the crisis period, and then has struggled against a backdrop of rising rates, strong US dollar, and so we've seen again some outflows. I think we're just below $1 billion year to date. So that again reflects it's a very useful tool in the investor's toolbox if they're looking to run and hide in the worst circumstances. Gold is often a great backstop for a portfolio. The final thing I'd say is, and it's interesting, we haven't touched on it at all in this discussion, but is just talking about currency hedging. And again, ETFs offer a great way of investors to not only get the exposure they're wanting in terms of the underlying assets, but also to manage the currency risk. And obviously we've seen an extraordinarily strong dollar. I was hoping to avoid mentioning it, particularly against sterling. An all-time low in sterling versus the dollar. We almost hit parity. That's obviously been reasonably positive news for a UK or a European investor invested in dollar assets, and it's sort of cushioned the blow somewhat of declining asset markets that we've seen this year. But if you think that the dollar is going to start to reverse, currency hedged versions of all of the products that we've been talking about are out there to allow you to manage that currency risk.
Sure. Lucas, commodity and energy and gold.
I think
what's your opinion?
Very, very interesting discussion and super relevant topic to discuss, because I think the whole movements and I think you alluded to the flows already, the movements we've seen really show that the ETF market is now at a stage where it's so broad, and also investors are increasingly sophisticated, that actually some of these more typical options, I'd say, on the commodity side or on the energy side, yes, they were used for tactical allocations, but actually to a far lesser extent than we would have expected maybe 2, 3, 5 years ago. And there are other products that are all of a sudden are much more used. So I think with the rise in commodity and energy prices specifically, I think a lot of investors pretty much looked through that immediately and already saw the link to inflation. So I think that's why, for example, in the year of 2021, like these inflation-linked products were traded very actively. We've now seen kind of the rotation back to pretty much plain vanilla treasuries out of the tips bucket, more into treasuries again. On the equity side, similar developments again. Not so much about, at least for us, not so much a story about single sectors anymore, but also basically looking at the developments from a factor lens, for example. Hugely important developments, I think Q1, Q2, really big story about, say, value and dividend investing. All of these, of course, pick up on some of these underlying trends, but are not as pinpointed anymore as a pure sector investment that also, for many, becomes close to uninvestable if you consider how the energy sector is composed and the lack of clean energy solutions in there. And I think the other interesting development that this period has actually shown is also like how entrenched, say, a trend such as ESG actually is. So we always said like how the most persistent pattern this year is probably the ESG adoption rate still and the flow momentum that we're seeing there. But actually performance on a year-to-date basis for ESG strategies isn't great, right? But clients are looking at these strategies. They have a solid understanding now what are the different performance drivers, and it's pretty evident that you take your 1 to 3% of underperformance simply coming out of your energy bucket right now. And that's accepted because it's very much in line with, of course, the objective of the strategy, and it didn't hurt flows or the momentum of this story at all. And it even opened up actually then the door for these new solutions. If we think about Paris Aligned, actually, I mean, we had like one very interesting client discussion where the client actually coined for us that term of fossilflation. So basically just inflation related to the fossil fuel sector, and basically then the attempt to look into strategies that move away from this as much as possible, and then something like a PAB strategy being a natural candidate that is also a lot less exposed to such developments.
It's a slightly heavier cost to pay to get in, but long term you won't be facing the inflation of a lack of investment in fossil fuel extraction because we don't need to extract it anymore. So that's a very, very good long-term page actually. Yeah. And risk-adjusted, to some extent, risk-adjusted. Okay, you haven't done great so far this year on a relative basis, but risk-adjusted, it still looks relatively attractive. So.
Well, many thanks to you all. It was I guess we got some amazing insights from you. I guess you deserve a round of applause. And well, we'll see each other around still. Okay?